Good afternoon. How are you? Let's continue to talk about growing your wealth through growing your assets. A number of videos I did in the past were how fees are killing your assets, how every 1% over 1% in annual fees is taking 10 years off of your retirement. I spoke about how you may need to switch your financial advisors, how to find a financial advisor, a fiduciary, what questions to ask, and you can find those at www.jasontweaver.com or here on my Facebook page if you want to see those. But just continue talking out of the books, Money Master the Game and Unshakable by Tony Robbins, and Peter Maluk also wrote Unshakable with him. But today I want to talk about how to have a balanced portfolio. One thing I always thought, and I think a lot of people think as well, when you talk about having a balanced portfolio, you think of balance in terms of the amount of money you're putting in, correct? So you say, well, if I put in $100 into my assets, into my portfolio, $50 will go here into this type of asset, $50 into that type of asset. And that's how we balance out our portfolio. But according to Ray Dalio, who's one of the top managers in the U.S. in funds, he said the way to have a balanced portfolio is in risk percentage, not in money percentage, or not in total of money. So I'll just draw a chart that they actually have in the book here to help clarify that if we split it up and we put 50 and 50, all right? 50%, 50%. So 50% will go in stocks, 50% in bonds in this example. But what that means is you're in risk, in risk calculation. That's actually a very unbalanced portfolio. Why is that? Well, stocks are really, the volatility of stocks are much higher than bonds. So stocks are going up and down all the time, correct? And they're fluctuating so much in comparison to bonds. So in that scenario, what Ray says is you actually have let me just write this here, a 95%, and I know it's backwards, I think, 95% risk in your stock and only 5% risk in your bonds. So your stock bond balance, your risk is very out of balance there. And so in terms of having a balanced portfolio, you want to look at the risk. And so you allocate percentages of what you put in according to the risk. So you put a higher percentage in low risk assets and a little bit lower, and a lower percentage of your money into higher risk assets. And as one of the assets is doing well, or one of the groupings of assets is doing well, say stocks are really growing and climbing, you don't just say, great, my stocks are growing, and sit on that. But when they're growing, and doing well, you want to actually sell off some of those stocks. In the good time, you want to sell. And then you want to take the money that you get from that and reinvest it back into your balanced strategy. So then you have, your 40% going to one type of asset, and your 30% going here, and your 15 there. Because what happens is, if you just let your stocks grow and you don't sell off and rebalance your portfolio, when the stocks go down, which they will, and then they'll come back up and go down, you actually lose your gain, right? And what happens in the markets is when one type of asset's up, you have the other side where the other side is down, and you can actually buy a lot more of that asset, of whatever, if it's bonds or stocks, you can buy a lot more for a lot less money, right? And when it's up, you can make money off of that. So when you take your gains, or some of your gains, you sell it off and you reinvest it in your risk balance strategy, you're buying a lot more of the low end. And then when the stocks level out and go down again and the other side grows, you actually make a lot more, because do you realize you sold off the gain, came back around and put it in there? And so, to have a balanced portfolio, you want to look at risk. You don't want to look at dollar amounts. You don't split it up according to dollar amounts. You split it up in percentages according to the risk of those assets. And then B, when you have an area, when one of the areas is growing and doing well, you want to sell some of it off and put it back into your balance strategy and rebalance your portfolio according to risk. Again, and then when it fluctuates again and one side gains and the other side goes down, you want to sell some of your gains and put it back in and balance it out again. So I hope these tips help you out on how to maximize your assets and your wealth, and to balance out your portfolio in a risk type of strategy versus a dollar amount, a money amount type of strategy. All right. Well, have a great day, and enjoy your weekend. See you later.